Good morning, everybody. Welcome back to the Opportunistic Trader. It is December 13th, and we're joined now by Brynne Kelly of the Fundamental Angle and Mike Korn to talk all things energy. They've been joining us regularly each Thursday to talk about everything across the gamut: nat gas, electricity, crude, you name it, they can talk about it. And so I'll let Mike and Brynne take it from here.
All right. Thanks, Mike. Good morning, everyone. Today's kind of an exciting Thursday for Mike and I because I actually made the jaunt out to Princeton.
Thank you for coming.
Yeah, so Mike and I get to actually do a little show today together in the same room, which it makes a big difference.
When you can, good to see you. Good to see you.
Yeah. It's great to kind of see your world and be in your office. And so we've been catching up a little bit this morning and want to get to some of that stuff. But let's get the numbers out of the way. First of all, we had our natural gas inventory number. Market was expecting 79, a draw of 79. And that's where the storage futures closed last night, and it came in as a draw of 77. So that in and of itself, came in at expectations. I think the more interesting part about the numbers that we're getting right now in natural gas is comparisons to historicals. And what that might do to some of the deficits that we have. This is the time of year where there's a lot of volatility in weather. And, when you're comparing summer numbers or even in the fall, they generally kind of look pretty in line with historicals. But now we're getting into, in December, the wide swings you can have from it being really warm to really cold, and you see that reflected in some of the this week's draws in previous years. The ranges are getting a little bit bigger. Next week they get even bigger, and we'll look at that in a second. And then I like my fun chart where I always like to keep track of the horse race. I guess maybe it looks like that, right? And what I always do is I look at things as a season. So I will look at, total performance throughout the April to October summer injection season compared to history, and same thing for winter. And the winter is 22 weeks, starts at the beginning of November, ends first week of April, 22 weeks. And so we've had 5. Is this 4 or 5 gone by now? I think it's 4. Anyway, so you can see on the very bottom is this current winter season, and it descends all the way back to the 13-14 winter season. And 2 things I like to look at the most are the yellow is the weekly average to date. So you kind of get a sense for the run rate, if you like, and you can kind of see over, because one number in and of itself doesn't really tell the story, but once you start getting your average as you move through the season, you can kind of get your analogs set. And we've been to the 2013-14 season. However, only 13 and 14 overtook us, and it's so you take that along with outright inventory levels, and you continue with your sort of bullish sentiment, right? Where inventory levels were much higher in any of these years, right? And yet we're still keeping pace or outpacing on cumulative withdrawals for the season. So, that hasn't changed. Nothing's changed. We still have a storage deficit, and the market is still very afraid of that. I'm going to jump ahead here, though, because if you look ahead at the next 2 weeks from here, so the next 2 inventory withdrawals, on the far right, you have your orange, which is this year. we were kind of talking this morning about how looking at where the weekly storage futures closed last night for the next 2 weeks, it's right now projecting a draw of 200 combined. And this is where you kind of start to see the weather effect, right? And if we look at, this is what the market has been contending with. I mean, and you can say whatever weather service you want to use, like a trend has been that, we went from this kind of jumpstart cold in the winter to leveling off. Above average in December means something different than above average in December. But you can see that playing itself out relative to prior years. I mean, even the last 2 winters, right? And for the next 2 weeks, they're big draw weeks. And the 2013, going into 2014, also a big draw. Just mathematically, if these expectations are right for the next 2 weeks, we will shrink the storage deficit just, by default, as those are coming in a little bit
getting
more.
Closer to the 5-year average.
Yeah, the deficit, of what we have. So, something to keep in the, back of your mind. Of course, we've been talking about the bullish story forever, but time sometimes, heals some, or changes narratives. And so it, be very interesting to see how those end up playing out. And I think the problem right now with natural gas is that we made a big move. Fundamentally, everything in the winter shifted higher, the entire curve. Cash at Henry Hub moved higher, went from trading 3 every day to trading 450 pretty solidly throughout the month. But there's now we're stalled. There just isn't another new catalyst joining us here, But look, the minute this forecast changes, that's why, we're going there. Everything is in place for it to move higher. If this, suddenly, we all of a sudden see these much belows pop up into the window. So, you can be, flat to, dip buyer in these areas, but certainly, don't take this price action right now as bearish. It's more stabilizing until the next event. And just before we dive into that rabbit hole any deeper, I know everybody's crude inventory numbers were yesterday, and everybody's talked about them to death. So I don't need to go into the minutiae of all the numbers. However, the chart in the lower right, is taking a look at inventories relative to this in natural gas. It's also changed the picture in comparable. So the far left is green, and then it, declines backwards in time. And, I'm not saying, these particular levels, they're not, they're like a no tell. And so, that this bearish sort of way that the market is acting at, from here, even after it's had a big sell-off, is based on sentiment, right? So you either have to expect that all of a sudden these gaps are going to start to widen again, and the comps are going to start to look really bad. It's not as if there is evidence in the cash markets any different, than we've had in the last month or two. So I like to point that out. I want people to just keep that in the back of their minds. I think it's such a non-story looking at, comps and where levels are, that I feel as though, and Mike and I talked about this, we're just going to see volatility sell off. the downside, a couple $5 maybe. It's hard to imagine upside moves because we saw crude being taken off the market. And so if price moves up, they'll put it back on the market, in Canada. And, so feel like we could just trade sideways for quite a while here while we wait for a new story to develop. I mean, it's played out.
Yeah, we've been trading sideways now at 2 weeks between $50, $52. Option expiration is tomorrow. So possibly that's one factor that may drive prices a little bit to a strike, maybe the 52s, 51 at this point.
Well, that's a really good point because a lot of times the market holds off on its next move. It's kind of held hostage by option expiration, right? So once we get tomorrow, the options, Jan options off the board tomorrow, it's like then, the shackles come off and Fed futures can make their move.
Yeah.
And there's, a lot of open interest at the 50 level. Just depends on, it's just, that's a big level.
Yeah, right now, but actually, so just bringing up open interest on the 50 put strike, 16,800 as of yesterday, actually day before yesterday. I did see that last week at about this level, and early this week, it got up to about 21,000.
Oh.
So there was a little bit of a move into buying puts. I didn't really see anything in the calls happening like the 50, 150, 52. The activity near the at the money strike, a lot of that are synthetic trades, etc. So it's hard to get a feel for just how much spec business right now.
And when you say synthetic trades,
just if I wanted to create a short futures, for instance, I'd buy, put, sell, etc. Yeah.
Well, I know yesterday morning the 5250 straddle was trading like 160.
Yeah.
And it's just like kind of going to pick their level and just grind it into zero by tomorrow, right?
Yeah.
So
on the way.
Yeah.
But this highlights the point that you've been saying. The sideways movement in crude the last week or two has been, especially with the volatility we have had, I don't think it's necessarily a welcome rest. But we went from hyper to dull pretty quickly in crude.
Oh no, I never did get that. Oh, never mind. Well, we were actually looking at that this morning, historical and implied volatility, and we've seen now the historical has moved underneath. We were looking at
we were looking both, and actually have some of the natural.
The oil one.
Yeah, I'll put that back up.
Okay, well, we'll come back to that. So, when people are asking like, okay, what now for natural gas until the end of the year? And I like to come at that a lot of different ways and see maybe where some of the pain points have been. And one of the popular trades in natural gas is index futures. And index futures are the difference between Platts Gas Monthly and Platts Gas Daily. So if you're buying it, you're buying monthly, monthly and selling the daily index and vice versa. So here, and when you look at if any particular month has dealt a lot of pain on first of month index versus how cash has settled out, you kind of get a sense for people's appetite for next month. And especially in the winter. I mean, we're looking at January at a lot of these coastal East and West Coast locations being above $10. So this chart right here, I have some of the, kind of across the country basis locations or hubs across the U.S. East Coast, TETCO and Algonquin. And we have Henry Hub, and we kind of move to the West Coast and some of the mid-continent. And the dark blue line on the left is where the first of month index was set. The next to it, we've already priced out 13 days. So we've cleared 13 days of cash gas, daily cash gas has traded. And this is the average price for the first 13 days is the light blue bar. And then in the kind of neon blue is where the balance of the month swing swap is trading. And so you can see in most of these cases, well, the index trade was a big loser. People paid up to own the entire month, and their index position on the cash side, because it's essentially a fixed for float swap, is settling way below. And, you know, this has been the biggest, you know, once you get into winter, you expect that. But now imagine that you're facing the same thing going into January. So you think about January futures expiration and then first of month index being set for January, and this big miss on December. Will some of the enthusiasm be lost at, you know, we saw it at expiration, December, just when the contract expired, I think it ran up to like 470 or something.
Yeah, that was a Friday. Was it Friday? It was Friday last week.
Yeah.
Wow, that feels like it was a long time ago.
Yeah.
It was Friday last week. And
no, 2 weeks ago.
2 weeks ago, okay.
Well, yeah. November something. But yeah, 2 weeks ago.
Okay, and I think that's the only time I recall where natural gas actually finished the day stronger. Like every day, a little bit before that, and in the last like week, 2 weeks, is just continuing sell-offs, except for that one expiration.
Well, you know, it exposes the upside, right, and kind of makes a move. But it's such percentage-wise big moves. It hasn't seemed to go out on the high, except for at expiration.
But then going the week before that, like the whole November, like we would. NYMEX would close, post-close, the market would continue climbing up. Yeah,
but not since we've made this kind of into the $4 range. And I mean, you know, there's history about, you know, natural gas just never living up to its, you know, the expectations. And so people get nervous, but, you know, there's a lot of pain going on some of these index trades for anyone who, you know, really was bullish and fixed their index at first of month because they were scared, as generally is the case. You get nervous that the daily spot prices are going to run away from you.
I have a question. Who's trading that then? Are you talking about like the BPs and Cokes of the world, utilities? Who actually gets involved in that? That's not so much a spec market, right?
Yeah, oh yeah.
What's a spec market? For those commercials? Or?
Well, so, okay. Great question. I never even think about it like that. Let's see. It is an ICE futures contract.
Okay.
Also traded OTC. So you have basis futures, index futures, and outright futures. It's a really easy way to financially play the difference between monthly and daily prices. And in that way, it's used heavily as a spec tool. On the other side, it's a very handy tool for producers or consumers. If you've hedged yourself in monthly futures, you can then convert it to daily hedge through an index swap, right? You can then sell your monthly and via the index, right? You can swap out your monthly hedge for daily price coverage. So it you know, on a forward basis, if you look at any of these locations, you know, they're generally plus or minus 5 cents around zero. So, you know, the expectation prior to that is, you know, your cash and futures will line up. But as the prompt contract reaches expiration, you know, people start to set their bets, right? And generally the bet is, I think cash is going to be way lower than this during the month. And so you would buy, right, the swap, or I think cash is going to be way higher, right? In which case you'd sell it. So you're, in that way, the spec play on the differences between cash and look, that's a big trade in electricity as well, too. They don't have index futures, but being able to play the monthly product against the daily real-time prices. And and you can run all the algorithms and all the models you want. There's plenty of historical data, and it's a big game. Daily, monthlies versus real time. And we see it play out a lot in the winter. So I would say just from thinking through this expiration now, as January is, be as enthused to commit at these monthly levels. I mean, obviously we've still got 2 weeks left. So this neon blue could completely flip and prices could, run way up and bring us to the level. But I mean, it's always the case at the big demand centers. SoCal and Algonquin are the two that stand out, right? Where first of month is just so much above the index. So I'm going to, watch that a little bit closer as we're getting towards expiration, but just know that there's a lot of people that felt some pain on those trades. And then just one final thing on the hot pink bar is next day cash versus balance of the month. So did today's cash price, is it higher or lower than the rest of the month? And if the pink bar is above zero, right, then it's over. So that's backwardation. And so we are starting to see a lot of these markets. Cash is right now trading over where the balance of the month. And, the expectation is we have these 2 weeks of Christmas. That's a difficult time to gauge demand versus weather because, globally factories shut down, window making factories and, schools, universities, all shut down for 2 weeks. And that's a loss of demand. And so trying to, estimate, what that might look like. And it's why cold weather or hot in the summer on a holiday always is a disappointment because you don't get the full market reaction that you would have if it had been, just a Wednesday in the middle of, January.
Yeah, I remember you mentioned that around Thanksgiving time, for the same lack of demand because of the shutdown.
And who's to say, that we, wouldn't have, looked, I mean, we're certainly strong, but who's to say it wouldn't have looked, even stronger. I mean, it just rambling off, but so many summers, trading electricity, you'd get the hottest day of the year and it would fall on 4th of July. It was just such a letdown. It's like if it had been any other day of the week, trade that, because load is just so much less, especially electric load on holidays, because you think about lighting in office buildings. I mean, sure, they're going to keep things at a minimum, like heat, but that's at the energy saver level. They're going to keep it, and they're certainly not going to have their lights on and all of that. So, so I found that interesting. I hadn't looked at it until last night, and it just made me think about what impact it might have on January expiration. Hey, Mike, I just want to check in with you really quick. Are we 11:30 today, or I'll just keep going? If maybe you can just you'll tell me when. Okay.
I say we keep going.
Right.
No one's stopping.
Right. Well, last week we had an hour.
Yeah.
So.
Okay.
All right. So now here we are. Right. Mike, we talked a lot about the Fed March spread. It was kind of a no-brainer. We were looking at how we had moved into expiration. Maybe not. And it looks like, this year the market kind of got ahead of itself, made the big move, and then just fizzled out.
Yeah, but look at that with the green this year. It made a couple big moves actually, because you can see off the low how it first peaked, sold off sharply, and came back. It actually made another high, and then got hit really hard.
Yeah, and it's that March finally got a bid. It's really that March was viewed as a non-event.
Yeah,
this is a non-player, and I think this is almost more reflective of March getting more of a bid relative to and which is an overall bullish sign actually
one of the things we looked at and we were contrasting earlier was the year before, the pinkish fuchsia,
purple,
pink, purple, how you had a spike straight up, and that was strong. That was going into expiration and finish, and there wasn't the let up. We were looking at the Feb March this year, looking for strength based on what we saw the prior year,
and sort of thought you'd have to wait for it. Yeah. And it just out of nowhere, kind of made its run, made its big spike higher, several weeks earlier. Yeah. And I think the market just got a little caught off guard. Last year is what that looks to be like.
We were wondering earlier, is that spread done now?
Yeah.
And looking just at that chart, feels like, or it looks like it has played out.
Well, you know what? So if I think about that, so if the market, if it's really in a bull scenario, I think the spread could be done, because now March also is going to run bullish. Oh yeah, where's the curve selling off a bit there? Huh?
Yeah.
And in a bearish scenario, the spread could actually widen.
Yeah.
Because they want to dump off March, and still believe that February could show some support.
Speaking of March, what's the highest in the last couple of weeks you remember March, April widening out to? Was it like $1.25? A little
higher. Yeah. April? Well, 160.
Got up that high?
Yeah.
Okay.
Yeah.
Because I'm seeing now March is a dollar. It's less than $1 premium to April now.
Well, yeah. And the thing about that spread is that it's one of the most popular calendar spread options that's brokered out there. And, you just see crazy things like people are buying the $10 calendar spread option, and tons of people, buy the flat puts. So that expiration is going to be exciting until then. Right? And then we look at some, just peeling it all back, trying to get, you try to get some comfort in like the prices you're at, to stay in a trade, like if you're long, or, kind of gauge when you might want to get in. Where it says that. We kind of, along the way, have been comparing this year to maybe the 2013-14 winter, even though they started with higher inventory balance than we did. And, this red dot is, 2014, 2013 expiration of January, right? December. Here we are kind of, sitting in that range. And it is funny how the market and hang out there a little bit. So, and kind of waiting before it might be ready to, we need bigger draws on an analog basis, right? To I mean, if we want to talk about it, the next range would be $5 to $6, right? We got in this 4 to 5 range. We need to start seeing some big draws to kind of get us into that new range. And of course, that would lead us to volatility, right? And this, not necessarily that I feel like this is indicating a trade per se. However, and you can even talk about this. Maybe I'll set it up for you, Mike. Okay. So the blue line, and this is January natural gas. And we're going to look at a summer contract too. We have the historical volatility, which is 20 days. And the red line is the implied. And I know Mike, especially when, we made the initial move up, really had a hard time, he's trying to get markets for clients from market makers, right? Yeah. And I think this picture tells the story.
Exactly. Who wanted to model volatility, or at least trust what their models were generating value-wise when volatility was in a hyper situation like that?
Yeah, because you were talking about the theoretical prices were looking just completely out of whack.
Right. So with this, I just want to point out two things. One, my source for this chart, I use CME Direct for my pricing, and this is their options package with it, Quick Strike. And if you play around with it, you get information like this in charts, which I find quite helpful. But in any case, what I wanted to talk about right here is look at the gap between implied and historical. the thing to note is when a model is generating theoretical value, they take historical, typically 20 days. So we were seeing options theoretical values that were crazy. I remember like the March 8 call and the March $15 call traded. The actual,
and hence getting a market
right,
of anyone. It was
tough, yeah. And then how do you balance between this is what the option premium is implying about volatility versus this is how volatile the future contract has been?
Right.
And it was sometime last week, maybe a week before, things were getting back to a more normal getting markets, trading at the spread between the bid and the offer was narrowing back to what it had been during com markets.
Yeah.
But historical was still up. And that's the value, or that's the volatility that's put into a price model to generate the theoretical value.
And I cringe. I just wanted to interject here. I feel like I can hear Vince in his, like Vince and Tom laughing or something like, "Hey, leave the options to us." But let us just have our little novice discussion.
Well,
hey,
actually,
guys,
if I could chime in, if I can actually chime in, Vince, as you bring his name up, actually does have a few questions. If you don't mind.
Yeah.
So he's
Vince,
saying, looking at one of the prior topics you were talking about, he says, does the daily cash versus futures play foster interest into APOs?
And
then does this problem, and then also, does this problem seem to be a rolling squeeze as end users keep covering their risk or just in time?
Well, the thing to think about for end users is end users are not usually paying these prices. End users buy from LDCs, and anybody who's a consumer of natural gas, unless you're just a massive, large industrial, doesn't really have access to these, I'll call them wholesale prices. You pay your local distribution gas company's tariff rate. So it doesn't act the same way as it might, with a commodity that there's a little bit more retail buyer in the market. But the first part, I think you were asking, how does it play into average price options?
Well, there really isn't an APO for natural gas options. So Vince may be referring to crude in this case.
Well, of course, a high volatility would make up a price insane, right? And it's like in electricity, you can buy a monthly expiration or you could buy the daily expiration for the month, and the cost is out of control. But what I will say is that it's driving a lot of interest into the index futures, which is the way people play the difference between the monthly volatility and the daily volatility. But I think maybe I didn't hear the first half of that question, Mike. I'm not sure.
I think part of
the first half, just reading what he's saying here, and he's actually typing, my APO question was a reference to daily prices versus monthly swaps you referred to.
Yeah, so, but did it drive more volume to it? I think that, anyway, I guess the bigger thing is there's not a big average price option market in natural gas.
No, I've never participated in an APO in natural. No. The two options with natural gas are, penultimate settlement and last day settlement.
Well, and the dailies.
And the daily
options, but they're single day, right?
Yeah.
So it's probably driving a little bit more on any given day, right, into the daily options.
One thing I really did not pay attention to, by the way, is in the volatile times in November, I never looked for a market. I had no one ask, and I didn't really have an interest in whether anyone was perchance making a market in a daily. That'd be crazy. I don't know where, you just have to say, I'll sell it at 10 cents or 20 cents. There's no real quantitative measure for that. But can I don't know if this is providing color to Vince's question, and I'll say this as a question. With natural gas, like every day, cash was ahead of futures. And it did feel like there was kind of a squeeze. And Mike mentioned that. And so when it came down to the end of the day, was there a genuine spike because people needed it, or did you get the feeling it was being squeezed along with futures?
I think
squeezed?
You picked up the essence of it. Yeah. Right. I know
when Michael said Vince said squeeze, that's the first thing I thought of.
There was cash. You always have to ask yourself, is cash completely reflective of constraints in the daily market, or is there some level of caught off guard, right? And it squeezed that up, and now that's kind of people have closed out their exposure, and we have seen cash. I mean, I think it traded 410 or something around that for today, so certainly come up about 50 cents. And the nat gas futures just don't really like it. When cash isn't supporting it, it will just pull down the complex. By the way,
if it's all right, I'd like to actually pivot to a question to Vince for a future answer. Okay, and that is, when you see a chart like this, implied versus historical, do you immediately look at, you know what, the option premium is implying a much lower volatility, I'll buy it? Or do you think, no, you're not, I'm going to sell that because historical, or the futures contract's historical volatility is going to come closer to line to the implied, as it looks like right there.
Right. Yeah.
So Vince and Tommy have an opportunity at some point.
At their next one, right? Wait, are they
already?
Or at all? Do you does implied versus,
because we were discussing
historical motivate you in either way? I would say, just is it completely not at all? Why, mathematically driven formula. I a lot of times feel better buying options when the implied is lower than but that's a function of skew and whatnot. But when at the money is lower, you kind of feel
kind of an intuitive thing.
An intuitive, but really the other side of that is that it's a sign that you're not going to get any volatility. Right? So don't take my word. So now just let's compare that to May options. And the reason I like to look at this is historical volatility for a particular contract, right? And 20-day historical volatility for January futures versus 20-day historical volatility for May futures. And it would look like this just about for any summer contract. And, it's a bit of a different story, as the summer contracts literally moved within the same 15-cent range. And look at even the difference in where we're at on volatility, spiked at 120% for implied, and here, we're just not, a little bit of a pulse above 30, but that's about it.
Volatility for the futures contract.
Yeah, I know.
Does that mean, because we've been discussing, does that make it a good case, or at least supports the case for buying a May straddle?
Well, it definitely represents if anticipation that what's happened and where we're at now is going to do something to prices in the market, but futures just don't want to. They don't want to cooperate, right? So it's almost like options are getting ahead of it. Really, a little bit. The markets move, and I mean, I agree. It seems like whatever the path is from here until summer, it's gonna be a volatile one. Whether it's a huge gap down, a huge gap up, but it's going to be a volatile one. And I mean, it could happen, and we just settle right back into absolute nothingness. But I would say until then, it's gonna be a bumpy ride. And I like picking up some of these summer straddles. I think 285 in May is trading around 40 cents, 38 cents, versus the February at the money straddle is over $1. So I don't know. I think there's a lot of ways in which you could have some opportunity on those. So I know we've taken up a lot of time. I appreciate everybody listening. Thanks, Vince, for the questions. I appreciate that.
Yeah.
Be mindful of the end of December and what it does to your fundamentals. It's not Anything that you would see if we were sitting in January, we'd have a much different reaction to it than we would sitting here looking at, staring down the next 2-3 weeks with holidays and also at the moment just kind of like average weather. So just be mindful.
Yeah, especially with all the action we've had.
Yeah,
those were times that people who've been in the markets a long time never really experienced before. We've had moves, but the rate of acceleration of those moves was spectacular.
Yeah, it was. Things you'd only dreamed of if you
were on the right
natural gas run up before, right? Yeah, if you're on the
dreamed
right
if you were on the right side.
Right. and I by no means think it's over. There's all the same conditions that could react really bullishly to other conditions, right? Weather, pipeline constraints. You get into January and you could have freeze offs. If the weather gets on production. So I know production is the big story, but there's a lot of factors. There's a lot still in play, but don't let the action of the next few weeks in gas sort of convince you otherwise. Let's put it that way.
Yes. Hey, Brynne, I want to thank you for coming out to the office today.
It's
a lot of fun to talk with you on the air and from a different location. It's a lot easier. I learned a ton when you present your analysis of the inventory levels and just the market in general. So thank you very much.
Thanks for having me.
Thanks, everybody.